Hello, everyone. Thank you so much for joining us today. I'm Marche, the webinar director here at Advice Chaser, and I want to welcome you. Before we introduce our guest and get started, we do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you this educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the presentation today as appropriate. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your contact information as well. We'll make sure someone reaches out to you after this event to make sure that question gets addressed. Again, we want this experience to be as educational as possible, so please don't hesitate to ask for a clarification or expansion of the material. I'd love to introduce you to today's presenter. Eric Maldonado is the owner and founder of Aquila Wealth Advisors, LLC, in San Luis Obispo, California, established in 2017. Eric has over a decade of experience providing financial planning and investment advice. He is a fiduciary financial advisor and a fee-only financial advisor. That means Eric and his team work under a fiduciary standard of care, putting their clients' interests first, and their compensation method is the most transparent and objective method available. Eric earned his MBA master's degree in financial planning from Indiana Wesleyan University and his bachelor's degree in business administration finance from Cal Poly San Luis Obispo. In addition, Eric has designations of certified financial planner, practitioner, and certified exit planning advisor. He has earned the certificate in blockchain and digital assets and is a member of the Digital Assets Council of Financial Professionals. Well, I am very excited to have you back, Eric, and we're going to launch right into this. And I think a lot of people are here are maybe this is a time that they're worried about their retirement. And definitely let's go ahead and address that. I know we have a great presentation planned for you today.
Yes, awesome. Thanks, Marche, for the invite and for the intro. Welcome everyone here live and those of you maybe watching on recording at a later time. As Marche mentioned, I'm in San Luis Obispo on the Central Coast of California, and happy to be here and help people with their retirement planning. And it's a passion of mine and something that I'm really excited to speak to here today. All right, shall we go on to the next slide? Okay, so let's start with a fun topic, retirement fear. Let's kick it off right off the bat with something exciting. But you know, that is a fear oftentimes for many people as we get older, is making sure we have enough. And so if I can summarize what we're talking about today, it's really the fact that we're probably going to be living longer. We are living longer. The average age of Americans is much longer than it was even 30, 40 years ago. I've seen some stats, you know, the average couple age 62, healthy, you know, non-smoking at retirement one of them is going to live at least another 30 years around there. So we're talking 30-year retirements now, which, you know, when Social Security was first invented, it was, you know, Social Security kicked in after the average age of people alive. So now we have to create our own, you know, Social Security. Social Security is never really meant to be, you know, a 30-year retirement income vehicle. So that's a big topic today is how much, you know, do we, just the fact that we're living longer, and then also what are some investments that are going to keep up with rising costs? Because as we live longer, costs continue to rise. So what can we invest in to keep up with those rising prices? And then how much do we need? So next slide here, running out of money. Inflation is a hot topic today, and other times I do these presentations and I kind of got to get a little bit more illustrative, if you will, on inflation today. We're seeing gas prices $6 and above. We go to the grocery store and eggs are twice the price. We see billboards every day at grocery stores or on gas station corners that show us prices are rising. That's really just what inflation means. It's the fact that prices for consumer goods, for anything, goes up every year. Typically, it's about 3% on average, but right now the days we're living in, it's like 8-9%, and that's the whole idea that everyone's trying to solve, and at the Fed or in the economy politically is trying to solve for inflation. So one of the topics is fixed income. A lot of times we're taught as retirees or people that are planning is, it's safe to get fixed income vehicles, which would be bonds. Another word for that is bonds. Basically, you're an owner of debt. You get paid a stream of income from a CD or a corporate bond or a government bond, treasury notes, whatever. But those are fixed income, and by definition, fixed doesn't grow. And if our costs are rising throughout retirement, then kind of by definition, we're setting ourselves up for running out of money. So in some ways, fixed income is risky. Fixed income investments are risky because it's not keeping up with the rising prices that we're seeing. So we can allocate that money towards other places, like owning companies, being an equity owner, owning businesses that grow and have growing income and growing dividends. We could probably go to the next slide, Marche.
Yeah, I know we already talked a little bit about inflation, but I thought this example was really illustrative.
Yeah, this is just, cereal. Let's say today it's $5 for a box. In 30 years, it's $12. So, prices rise about 2.5%. Sorry, 2.5 times. So if it was 5, now it's 2.5 times more. It's $12 for a box of cereal over 30 years. And I use 30 years because that's about how long, like I said before, a healthy couple is going to live in retirement. And some people might say, well, I'm not preparing for a 30-year retirement. Well, it's preparing for you because, we might not think we're going to live longer, but I'm sure we can all think of someone that is age 100 that we know firsthand, which, no one thinks we're going to live that long, but somehow we know people that are living that long. Maybe it's not all the way to 100, but, and maybe you don't have to get to 90. Some people are retiring a little bit earlier. If you retire in your 50s, then you're going to live to your 80s, possibly and beyond. That's 30 years to create income and also to kind of battle rising prices. That's kind of the silent assassin, if you will, of retirement is the prices rising as we retire. Go into retirement. Go ahead. So again, not to beat a dead horse, but we need to find a way to invest in things, assets that give us a real fighting chance to continue to preserve the lifestyle that we're used to. Most of us don't want to have to make extreme cutbacks in our lifestyle as we get older. We still want to, do stuff, travel, help grandkids, help people. So let's talk a little bit about investing in the stock market. Another word for stock market is equities, or essentially owning companies is what I'm talking about when I say stock market. So like the S&P 500, for example, which is the largest 500 companies in America. Pretty much any name brand clothing you're wearing or store you go to is an S&P 500 company. Apple, Verizon, Home Depot. So when you invest in, the stock market, you're actually owning companies. You're a part owner in a business. Essentially, you own shares of a business. And I feel like due to just the way the financial media talks about things or headlines, oftentimes stock market makes it seem like it's this, crazy machine of a device that's just always going up and down. It's in turmoil, or there's euphoria, or it's just this almost like a gambling machine that creates money and sometimes takes money. But I think if we kind of bring it down to the fundamentals of what the stock market is, it's owning good companies, owning profitable companies, billion-dollar companies. And that's what allows us to continue to have our income rise potentially in retirement is to link up with these companies that are growing their income, oftentimes growing their dividends, and thus allows us to increase our income. So these are some of the aspects or elements of owning businesses. You own the equity, which is the actual price. So when you look on, your Yahoo Finance or your stock app on your phone, the price you see, that's just the equity price. That doesn't include dividends. Dividends are also added oftentimes quarterly to your portfolio if you own dividend paying stocks or stock companies. Typically the bigger companies that have been around longer, the Fortune 500 companies, pay dividends. Usually smaller companies or some like emerging market companies don't really pay as much dividends, but there's still dividends that are being paid in. Roughly half of the return of the S&P 500 is from the dividends that are being paid out. And those dividends historically rise over time. And actually the average rate of raising of the dividend is more than the average rate of inflation, which is kind of what we want. We want to invest in something that is increasing more than our prices are increasing. That way we can maintain our dignity and independence in retirement. We can go to the next slide. This is called an Ibbotson chart. It's just a name brand. Ibbotson, it's someone who provides historical returns in a very simplified, easy way. I just tried to find the simplest one. The blue lines, you can just look at that as owning businesses. Those are owning companies. The S&P 500, those are the blue lines kind of going up. The orange and green is owning bonds, government bonds or treasury bonds. And then the grays are inflation, kind of the silent killer like I was talking about before, that is essentially eroding our purchasing power. So the main takeaway here is at the end, I want to show the distance. You want to look at the gap or the distance between the blue lines and the orange line, and then the blue lines and the orange and green line, that's the bonds. You get more bang for your buck when you have blue line investments, which is the stocks. And then look at that as a comparison to the distance to the gray line. It's that gap from the gray line to those lines is what our money is returning for us. And going back pretty much 90 years here, the blue lines are always roughly twice the distance than the orange and green line. In other words, you're getting double the real return from owning companies than owning bonds. And that's what you want. You want the distance from your inflation to be as high as possible, so that way you actually have the same amount, if not more money than what you started with in retirement. So another way to say it is people say that owning bonds is really safe. And it is in terms of the ride that you take. The ride that you take, if you look at the orange or the green line especially, look how smooth it is. That's, we're going from left to right from 1926 all the way to 2019. That's showing you the fluctuation in prices. You get a smooth ride, but that smooth ride barely keeps up with inflation. Whereas if you look at the top line, the blue line, the navy blue line there, it's much more jagged, much more up and down prices. But if you zoom out far enough, it looks like a blip on the screen as opposed to like the market's tanking. But when we zoom in and we're living life day to day, it feels like crazy extremes. And as long as we don't sell, we don't lose. But if we sell and we lose, we blame it on the market because it's, we say the market lost money. But as long as you keep holding on to your investments, and it's easier said than done, of course. If you look at towards the end around 2008, Marche, that the big blip in the
You're talking about right here.
That's the Great Recession. On the screen today, it doesn't look like that much, but at the time, that was the end of the world, right? Mm-hmm. And then if you go a little bit further to the left, around the year 2000, 2001, that's the dot-com bust.
Right here.
Which again was another
I see. Right here.
Almost the world-ending type of a moment. But now Marche can barely even find which
where to put the arrow. Yes, I see. It's about right here.
Yeah, 70s down there below, where we had some market going down. Last period actually, where we had great inflation, like today, similar to today, not the same. But those were also like kind of world-ending type events, but if you look on the screen, it doesn't feel as big. So we're trying to get those 10% annual returns, which I don't know if you can read the numbers there at home or looking on your screen, but large stocks shows about 10% annual return. That's like the S&P 500, whereas bonds is about 5.5%. So if you take out inflation, large companies is about 7% real return, and bonds is about 3%. So you get almost pretty much double, a little bit more than double for owning companies. And that's why my argument is actually safer over the long run to own a diversified portfolio of equities that you can hold on to, as opposed to owning bonds because you think it's safe. Because in reality, it's not safe if you run out of money. Who cares if you're safe if you have less money than you need to live off of? Okay, so that's kind of what I was talking about with the asset allocation and diversification. You still want to be diversified within your equity ownership. You want to own a bunch of companies, large companies, small companies, US, international. That way you're solid in your entire structure of what you own. That's the diversification. Asset allocation is, in short, stocks versus bonds versus cash. Those are different assets. Those are the three main assets: stocks, bonds, cash. And if you're going into a raising cost retirement, what do you want to own more of? Stocks that are raising with it or bonds that are fixed income? Probably stocks. But it sounds scary and it feels even counterintuitive because everyone tells us, own less stocks, own more bonds the older you get. But if you just look at the historical return, again, it's historical. We don't know what's going to happen in the future. But I mean, to me, if you look at 90 years of history, the probability, you kind of got to go with probability as opposed to possibility. What could happen? Anything could happen, but what's probable is what we want to kind of link up with in terms of our investments. And someone might say, well, what about other assets like gold and silver, private equity, all those things? I mean, those are kind of, those would be different types of assets, but the main ones are stocks, bonds, cash. I mean, you could even probably include real estate. I mean, real estate is kind of owning equities because there's plenty of real estate companies that are publicly traded and they own, apartment complexes or storage units. Okay, we can move on to the next slide there, Marche.
I think we've already covered some of this about bonds. Can you talk about municipal bonds, what those are?
Munis, especially if you live in like a high tax state like California or New York, muni bonds essentially allow you to get income, fixed income, without being taxed, state taxed or federal taxed. Depends on the muni bond, but some people are really big into those in retirement because if you're in a high tax bracket or a high state tax, you like the idea of getting some tax-free income, which I'm a big fan of tax-free income as well, but it still doesn't solve the problem that it's not going to rise with your cost of living. So I'd much rather have enough money and pay some tax than have tax-free income and not enough money. So the municipal bonds, although oftentimes they're touted or advertised as kind of the solution to retirement, it's still a fixed income product, and it's not gonna rise at the rate that owning companies paying dividends can or will.
We touched a little bit on real estate. I do want to spend some time on this because lots of people do own like a second home, or they downsize or upsize and they might want to keep their family home or want to purchase other real estate. So can you talk a little bit about that?
Yeah, real estate is another avenue to create income, and someone might be watching this and they are a real estate investor and that's what they believe in and focus on, and you'll get no argument from me on it whether or not that's a possible way to build wealth. For sure, real estate is one of the main ways that people build wealth in America, just owning income producing real estate, whether it's apartment units or residential real estate. It's another asset class. Typically involves more work. I'm biased towards owning what I would consider like true passive assets, like an S&P 500 index fund, for example. Because real estate, I mean, even if you outsource management and you own the property, you still have to deal with taxes, maybe tenants, toilets, depending on how much you want to manage it or not.
Mhm.
But some people, they just like the tangible aspect of real estate. They want to be able to see their property, touch it, feel it, know it's there. They like kind of the I don't know, the solidness of it. I mean, real estate's been around forever, right? You can own buildings going back for a long time. So there's an argument to be made. The other thing is a lot of people already have real estate in their balance sheet, meaning if you look at what your total assets are, a lot of times your home that you own is a big chunk of your asset. I mean, and there's argument to be made on whether or not that's an actual investment, because if you have to sell your home in order to provide for yourself, it's kind
Where are
of
you gonna live? I can see that.
But in terms of like your total assets, like if you take the equity of your home, that's typically a big part of your balance sheet already. And owning more real estate, if you go and buy more properties or rentals, that just continues to tip you into that one asset class. Whereas owning companies inside of your retirement account at work, or just a brokerage account, it diversifies you a little bit, as we were talking about before. It diversifies you into another asset class, which is owning companies. But there's plenty of people that are and will continue to have real estate be a huge portion of their retirement income.
We did have a question here, and we didn't really touch on it in the slides, and I thought it would be appropriate to bring it up. Can you speak a little bit about annuities? This is not a webinar about annuities, but definitely that it's, for some people, that is a component of their retirement.
Yeah, a lot of times annuities can kind of fall under the fixed income place, where if you get an annuity, basically an annuity is an insurance contract. You give the annuity company money, and they promise to pay you income for however long you designed the product for. I don't sell annuity products, but that's the general idea. Is you're trading dollars, today, to get insured for income for some amount of time. Some of them are lifetime, some of them are X amount of years. But you're still, in my opinion, muting or putting a governor on your ability to get returns that keep up with inflation. There are some annuities that are linked to indexes or certain stock portfolios that allow you to have an option or a chance at growth. But most people know that annuities, you don't get the insurance for free. You have to pay for the insurance to the company. So after fees and all of their various kind of parameters that they put on it, you're still back to kind of a fixed income product. And if you start soon enough, or if you have enough assets outside of annuities, you can still create your income, but have more control and freedom over your assets. Usually if you put it into annuity, it's kind of stuck in there and you can't really get it back. Whereas, I'm a little bit more biased towards freedom of being able to use your money however you want.
All right. And then we had another question about real estate. What about, I hope I'm pronouncing this right, REITs and their possibility?
Yeah, REITs, a real estate income trust. That would probably fall under even owning companies. You can always have a sliver or a portion of your equity portfolio inside of REITs. REITs is just another publicly traded company, and they are essentially your managed real estate provider. Their mandate is to create income for their investors by owning real estate, and it could be apartment units, it could be commercial real estate, retail, healthcare facilities, storage units, billboards. So there's diversified real estate you can own in your portfolio as part of your equity diversified portfolio.
Thank you. Well, let's go ahead and move on. Thank you so much for the great questions. Keep them coming, and we're happy to answer them as we go along. And again, if we don't have time to take your question, we can try to get that at the end.
Yeah, this is going along with the overall concept of retirement planning. As a retirement planner, it's just not all about the investments. It's about cash flow, insurance, estate planning. So I like to create what's called a recession-proof fund for my clients, which basically allows you to have a bit of a stress valve, if you will, when you retire, in case the markets take a turn south, go down right when you retire. Because someone might be listening and they might be asking, well, if I'm essentially retired and I'm not having any more working income, and all of my investments are owning companies, what if it goes down in the beginning? Or I don't want to keep taking money for income from my investments if they're down 20, 30+%. And I'm with you, that's a valid concern, which is why I advocate for putting aside a chunk of money that's just in cash or money market upon retirement. So it could be up to 2 years worth of living expenses. So if a year's worth of living expenses for you is 100,000, just to make up a number, you peel off 200,000, 2 years worth of expenses from your retirement investments and just put that aside in money market or in cash. And that becomes your life raft or your buoy, as I say there, to allow you to stop selling your investments to create income and just create income from your 2 year from your 2 year recession-proof fund. And it allows you to sleep at night a little bit better. It's kind of a, like I say, a stress valve. It reduces some of the stress when maybe you're seeing headlines or reading news articles about the stock market plummeting, and you can't help but look on your investments and see it drop. It prevents you from having to look at your investments every single day. That's not a good thing. Look at them every single day. You'll end up being more stressed and thinking about it more, and wasting more time thinking about your investments than enjoying your retirement. So this 2 year cash fund is a little bit of a peace of mind fund. So let's talk about how much can you withdraw from your retirement. And this I just show here, what's the average real return. The real return that you get on your S&P 500 fund or whatever you're invested in your diversified portfolio is the nominal number. So if it's 10% per year minus the inflation, which is 3%. So 10 minus 3 is 7% is your actual real return that you're getting on your money outside of inflation. And if you're withdrawing around, we'll just say for the sake of this example, you're withdrawing about 4.5% from your retirement investments. It leaves you a little bit of a buffer. If you're withdrawing 4.5% and your real return is 7, there's still some buffer in there in case it's a down market or in case there's a few years where it's below the average of 10%. It just gives you some play there to get your income right. 4.5% is not a magic number or a specific science number. There's art and science when it comes to financial planning. It's personal as well as finance, but that's a good rough estimate for you to know how much you need. If you can take out 4.5% of your investment of your total nest egg every year and provide for your lifetime, your income to provide for your lifestyle, then you're in a good place to be. Obviously, you don't want to draw something like 10%. If you take out 10% every year, you're going to be out of money in 10 years. But you don't want to take out like 1 or 2% of your nest egg, because that's just such a small amount of a percentage. You'll need way too much money. You'll never get the amount you need. It's so right around 4.5% is a good kind of happy medium. We can go and go on to the next one. Okay, this is speaking about retirement, cash flow, just a case study example of a couple here. We can kind of put a little bit more color to the scenarios, paint a picture for us. So John and Ann, let's say they want to retire at 65, and let's say they have income of retirement savings. That's what it'll be made up of: retirement savings, Social Security, and they also have a rental property. And we'll just say after their rental income and Social Security income, they'll need about $10,000 per month just from their retirement savings. So 10,000 times 12, they need about 120,000 per year to create a retirement income fund from whatever they saved in their investments outside of their rental and their Social Security. And so if it's a 4.5% drawdown, they'll need about $2.7 million. So that's kind of their bogey or their target. So let's say if they're 55 now and they want to retire at 65, they have 10 years to get to that 2.7 million roughly to create that 4.5% income. And if they're invested in equities, it allows them to continue to raise their they basically will give themselves a 3% raise every year. So 120% in the first year, or 120,000 in the first year, sorry. They'll add about $1,000 or so, something like that, to their income every year. And they get to raise their income with some confidence because they're invested in companies and dividend paying companies that are also raising the prices or the dividend. So, and then also at that time, they would want to include in the plan to create about a 2-year buffer of cash. So if it's about 120,000 they need per year, they'd want to create, on the conservative end, about $240,000 of cash. So if you add that to the 2.7, they need about 3 million total come age 65, and that gives them a target to aim for. We can go to the next.
Let's go into another example, and then I'm sure we're getting some questions, and I'm going to hold your questions, folks, to the end. Let's keep going.
Yeah, absolutely. Thanks for asking those questions, by the way. We'll get to them. So this is another scenario. Brenda is a teacher, and she wants to retire at 70. She has STRS, which is her state teacher's pension, and then retirement savings. And she still needs to create, she estimates she needs to create about $5,000 per month on top of her pension that she's going to get. And that would be, she would save in her 403B at work, or maybe she wants to save in an IRA or just a regular investment account or a trust account. So that'd be about $60,000 per year that she needs to create from her investments, which is about $1.3 million that she would need. So if she has 1.3 million at age 70, and she withdraws about 4.5% every year, that'll create that $60,000 per year for her. And then we want to add, if we can, on the conservative end, the 2-year cash fund. It could be 1 year, 6 months. Some people are across the board on how much cash, but we want to go towards most conservative. If someone's feeling especially maybe concerned with how the stock market's going, she would need to add about 120,000. So her total all-in number goal is about 1.5 million. So let's say she's 50 now. She has 20 years to get to that 1.5 million $1 million number. Yeah. And then this is just a little maybe encouragement or word on what the true value of what I do of financial planning. I mean, the investment planning is really important, which is based on the plan and the goals, which we talk about. But in some ways, it's more about the emotional kind of counseling, the human nature coach, if you will, because by nature, none of us really wants to see our money be less than it was yesterday when we look at our account. So we tend to, left to our own devices, we tend to sell at the exact wrong time when the market's about to come back up. And then also on the flip side, we tend to buy at the wrong time also when things are looking rosy and it just went up, or we're also prone just by human nature to put all of our money in one idea that we feel is the best one, whether it's a hot stock or crypto or whatever the scenario is. So an advisor becomes kind of a human buffer between you and our human nature to just either get scared or give into euphoria and the next best thing that's going to get us there. In other words, the financial advisor provides some regular doses of investment vitamins, vitamin C, vitamin D, just reminders. We need constant reminding that this time is, although it's different in the crisis we're experiencing, whether it's inflation, Russia invading Ukraine, political races happening. Those are all unique in their own right, but they're all similar in that we've experienced these types of things in the past. As we looked at on the Ibbotson chart, we've had inflation in the past. We've had crazy, political environments. We've had, terrorist attacks. Now these past few years, we had, COVID-19. So they're all unique in the event, but they're similar in that our human nature causes us to, sometimes want to do the wrong thing when it comes to investing.
All right. Well, thank you so much. and we're going to go ahead and go on to questions right now. And I have a few. I just want to make sure that, I think you already mentioned that, but I just want to make sure this question gets answered. How many years is that retirement kind of, when you retire that, oh, I don't know what you called it exactly, that fund that you have for the first couple of years of retirement, how many years is a good number?
Yes, I call it a recession-proof fund because if you retire and it happens to be a recession, the market drops 30%, that's probably not the best way to start your retirement, drawing down money. You don't want to draw it down at the bottom. You want to give yourself at least some time for it to maybe not get back to where it was, but at least get back on the upswing, because you'd hate to start drawing money at the very beginning of retirement and kind of pillage your nest egg at the front end. You want to give it a couple of years to be able to keep up with inflation and invest and take advantage of the probability of the returns growing higher. So again, it's an art and a science, but roughly about 2 years. If you look historically at some of the worst recessionary periods, by 2 years is when the market starts to go back up. Maybe it doesn't fully recover, but at least it's starting to get back into the direction of positive returns. So that would be like a conservative number. Some people might say, hey, look, I want 3 years of cash, and to each their own, but 2 years is a good amount of living expenses. So if you need $100,000 per year to live off of, just an estimate, you would want to create about $200,000 of a side money market or cash fund, something that doesn't fluctuate, because even bonds can lose money. So I wouldn't necessarily want to put it in bonds, even though it might be tempting to want to get some money while you wait. It's not really meant to be a return vehicle, that recession-proof fund. It's just meant to be a backstop in case in the first year or two of retirement, it's a market correction or a bear market.
All right, we're going to go ahead and go on to some more questions here. Again, I will just let you know, go ahead and put your questions in here and we'll try to get to that, as many as we can. All right, here's a question about, those numbers you put in the case studies. They're pretty big numbers. Is that actually doable? Like doing 2.5 million to some people might feel amazingly out of reach. How do you actually get to that number? Can you explain a little bit about that?
Yeah, so I'll do some math here for us on the fly. Pressure's on, but let's say
all right,
2.5 million is our target, and let's just say, for the sake of this example, we have 20 years before we have to retire. Let's say we're 50 and we want to stop working at 70 if it's up to us, and let's say we can still get the 10% average return, as we saw on that Ibbotson chart going back 90 years. About 10% is the average annual return. It's usually never exactly 10% per year, right? It's usually down 20, up 10, down 1, up 30. So, but if given enough time, 10% nominally is the nominal number, what we would hope for. How much do we need to save per year, given 10% rate of return, hope or probability, and 20 years of retirement? Drum roll, please. Just kidding. You would need about 3,000 a month to save. Okay, 3,000 a month is kind of your number to get to. Let me check my math. 3,000. Make sure I gave the right number. Yeah, 3,000 a month will get us to close to that 2.5 million. And someone might say, well, I don't know if I can do that. Well, at least now you have 20 years to figure out either to need less money to have your expenses be lower, to find a way to increase your income, maybe, find ways to get a raise or do some business of some sort, things like that. It's better to go in knowing what you need, as opposed to, keeping your head in the sand and just saying like, oh, I'll figure it out when I get there. But, obviously if you have 30 years and that number shrinks, if you only have 5 or 10 years, you're going to have to do more of the hard yards on your own to invest, and the market's not going to provide as much of a kickstart for you. But hopefully that gives them an idea, a monthly savings into your 401k or an IRA or just a brokerage account, trust account.
All
Yeah.
right, let's
Great question.
talk. Yeah, that is a great question. Another question came in about if you have an income stream of interest and dividends, would you adjust your recession-proof fund if you've already got kind of a cash flow with interest and dividends?
Yeah, again, that's kind of, there's a personal component of how either conservative or aggressive you feel in general. So, for example, if someone has, very certain income streams in retirement, like Social Security, maybe they just know their retirement property is going to provide what it'll provide, and they're confident in their dividend streams or their income streams. Maybe you're okay saying like, okay, if I need 10,000, I know 5,000 is going to be certain because I have a pension, Social Security, and a rental property. So I only need 5,000 per month to create a recession-proof fund. And then now you only need 120,000 for 2 years, as opposed to needing 240,000. So, I would still lean towards, a little bit more cash, 1 or 2 years of cash, if your main vehicle for creating the income is capital markets based, stock markets based. But one thing that might be helpful also is as you get 5, 6, 7, 8, 9, 10 years into retirement, that cash fund hopefully will be less and less of a necessity, because that gap between what the market is doing and what inflation is doing should be increasing. In other words, we should have more money at death than when we started. We should have a problem of having to figure out who to give this money to.
That's a pretty awesome problem to have.
Yeah.
Can you talk a little bit about taxes and how taxes affect your retirement nest egg?
Yeah, absolutely. So that's a whole planning topic alone. But in general, we have in America these great tools that allow us to save with tax advantaged, assets. So I'm a big fan of the Roth IRA or the Roth 401k. Roth IRA, individual retirement account. You can set that up outside of your employer, or a Roth 401k if your employer, or if you have a business, you can create one for your business. The Roth essentially just means that it's tax-free in retirement. In other words, if you have $1 million in a Roth IRA or a Roth 401k and you pull it out in retirement, you start taking money out, you don't pay any tax on any of the money. You don't pay tax on the gain, on the dividend, on the interest. It's all tax-free. Now, someone might say, how's that possible? Well, it's because when you put the money in, you put it in after tax. So you already pay tax on it from your paycheck. Let's say you have $10,000 in your bank account and you put it into your Roth IRA over a couple of years. That money has already been taxed. So now you're allowed to invest it for as long as you want. And then when you go to pull it out, all that gain is tax-free, and the principal, you don't pay any tax. So that's a huge resource. You could put about $6,000 a year into a Roth IRA. You can put about $20,500 into a Roth 401k. So between the two, we're getting close to that, $30,000 number per year of savings. So that's kind of what I would put as the gold standard, the Roth IRA, the Roth 401k, but also the pre-tax, just the traditional 401k or the traditional IRA is also really valuable. You get a tax deduction when you put the money in, so you get a little bit of a tax break. You put the money in pre-tax, and then it invests tax deferred. So any of the dividends you're getting while it's investing, any interest, any gains, you don't pay tax every year that those happen. You only pay tax when you pull it out one day in retirement. So that to me is kind of the negative is, when you're retired and pretty much need the money most, now you have to pay tax on all that money. So if you have $1 million in a retirement account, it's actually only like $700,000 of true spending money after you pay taxes, which depending on the state and how much your income is, in general, what your tax bracket is, it'll vary. But the traditional IRA and the Roth IRA or 401k are two of the main vehicles. And then you can still save into a brokerage account, which is a non-retirement account, which is still really beneficial because if you hold the investments for more than a year, you get capital gains tax rates, which are usually less than regular income tax brackets. So if you hold a stock, for example, for more than a year, you now qualify at long-term capital gains rates, which can be as low as 0% if your income is low enough. So you can basically, create tax-free income from a brokerage account, but it's as high as 20%. So if you're in like the 39% tax bracket, you'll only pay 20% on your capital gains. It's still you still pay half. That's still a great discount. And a brokerage account, there's no limits on how much you could put in per year. The downfall is you'll get a 1099. You'll get a 1099 every year on any dividends or income you make. So you pay tax every year.
We've got some other questions coming in. If you've been contributing to a normal 401k for say 20 years, and your company is now offering a Roth 401k, does it make sense to switch your 401k inputs to the Roth?
Yes.
Okay, so that's a big yes. All right. And then what about doing a Roth conversion? They said, I know it's a big tax hit to switch, but can you talk a little bit about Roth conversions?
Yes, and let me put a little disclaimer on the yes that I said kind of emphatically. It's half tongue in cheek, but some people, it might feel too painful to like, I was used to getting this tax deduction, now I'm not, I'm putting it in the Roth. And the argument to not doing the Roth, especially later in life, is someone might say, well, you're going to be in a lower tax bracket when you retire. But to me, I don't know that. If anything, most people consider the tax brackets we're in America now to be like all-time low tax brackets. No one is, in other words, predicting that we're going to be in lower tax brackets in the future. Most people, political pundits or whatever, are expecting taxes to be higher. So from that perspective, I don't know if it's going to be lower tax brackets later. But some people might say, well, I'm going to be retired, so I won't have as much income. I'll probably be in a lower tax bracket. Again, that's not certain either. And in a weird way, to me, that's kind of a little bit of a oxymoron in terms of you basically want to have less money when you get older, so you'll be in a lower tax bracket. So that way you'll take money out of your retirement account at a lower tax bracket. It's basically saying, I want to be poor later, so that way I'll owe less taxes. And to me, I feel like most people, they want to be doing better every year. Even though you're retired and getting older, you still want to be enjoying life, providing for your grandkids or people that you care about, or, giving to your church or organizations you care about. So that to me all is a long-winded say of like, you're betting on yourself to continue to be in a lifestyle you want, and by having a Roth. Because if you have a Roth IRA, you want to have as much income as you want per year, because every dollar you get out is tax-free. So you're kind of encouraging yourself to be to have assets later in life. Because if you have a rental property, Social Security, and that's still income that's coming in. So yeah. And the Roth conversion question, sorry.
Let's talk about Roth conversion. So you have a 401k. Talk about the process of doing a Roth conversion and how that kind of works as far as tax wise.
Yeah. So typically you have a 401k. Let's say you're 65, you retire. Usually you roll that 401k into an IRA. So it's now your own individual retirement account. It's not with the company. And then once it's in an IRA, you can then convert it to a Roth. And a Roth conversion basically just means you pay the tax today in order to continue to have it grow tax-free in the Roth. So you would want to definitely consider your tax brackets. Maybe you do it in chunks. Some people like to do it in chunks, so that way they fill up a tax bracket and then wait to do it the next year and fill up their tax bracket with a Roth conversion to make the most of that tax bracket you're in. And then ideally you want to be able to pay the tax, come April when the tax bill comes, you want to be able to pay the tax with cash outside of the retirement account. In other words, you don't want to pay tax with the money you just converted. That would kind of be like, you just undid what you created. So you always want to, so if you convert 100 grand and now you owe $30,000 of tax, you don't want to pay that $30,000 from your Roth. You want to pay it from cash you have separate. outside of your retirement accounts. That way you're not, killing the retirement nest egg that you're trying to create.
And I will say that this definitely is something that we can do another webinar on. It sounds like that this is an important question to a lot of people.
Yeah.
All right. Well, I'm going to take one more question and then we're going to go ahead and close. And I will tell our viewers, go ahead and put more questions in. We'll go ahead and save the chat and then get back to you. All right. So if you're 50 with $1 million in your 401k, would it make sense to continue contributing to the 401k, or would it make sense to start a Roth IRA to be more beneficial?
Yeah, from a tax diversification, meaning if I want some tax-free, some pre-tax, some taxable, it makes more sense to start putting money into a Roth. Because if you look at your entire pie of assets and there's no tax-free slices, you want to try to get some tax-free slices, and the Roth would be the way to do that. So if your employer has a Roth 401k option, you can switch to the Roth 401k, and just usually there's like a toggle or a button you can click on your login, or you can talk to your payroll people, and you can switch to Roth. And then if or when you go to retire, some people might say, well, I'm already 50, I only have 10 years for the Roth to grow tax-free. Well, that doesn't mean you're going to start pulling from your Roth right when you retire. You can still pull from your Roth last. In other words, you can pull from your pre-tax first and give your Roth another 10, 20 years to grow if that's last. So you can kind of look at it as stages. You can spend your taxable money first, your pre-tax money next stage, and your tax-free money in the third stage, the last stage, because you want your tax-free dollar to have the longest amount of time to grow. That way you have the most, tax-free gains.
Well, I want to thank everyone for being here today. Look for an email soon with a link to the replay of this event. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we'll see you at another webinar soon. Goodbye, everyone.
Bye.